You know, usually when we look at the financial health of a company, the math feels fairly intuitive. It's like a lot like balancing a household budget, you know?
Right, yeah. More money coming in than going out.
Exactly. You want more money coming in than going out. If a business is just, sitting on this massive mountain of cash, it's a winner. If it's bleeding billions of dollars, well, the alarms start ringing and you probably want to run for the hills.
Which is, I mean, it's comforting to look at the world that way. It makes sense.
It does, but then you step into this modern mega cap tech arena, and suddenly, like, the fundamental laws of financial physics just seem to shatter completely.
Yeah, it's a totally disorienting landscape.
Hmm.
We're dealing with these architectural complexities where surface level numbers actually, well, they actively mislead you if you don't know the underlying accounting mechanisms at play.
Which I think brings us to the core paradox we are looking at today on this deep dive. Because we have two companies that basically define the modern economy. Company A is generating, what, over $120 billion a year in pure, unadulterated free cash
A
flow.
staggering amount of cash.
Right, just an ocean of cash. Yet by almost every traditional metric, it looks dangerously overvalued. But then you have Company B on the flip side, which is currently bleeding, $7.6 billion in negative free cash flow over the trailing 12 months.
Which sounds terrifying to most
Well,
people.
totally terrifying. But as we're going to see, it might actually be hiding one of the greatest value bargains of the entire decade.
It sounds like a riddle, honestly, but it is just the reality of evaluating Apple and Amazon right now in the summer of 2026.
Yeah, so welcome to another deep dive. Today's mission is just monumental. We are unpacking two massive, highly detailed equity research reports from July 2026 covering these absolute juggernauts.
And we're going to get really into the weeds here.
Oh, definitely. We're going to look strictly under the hood of their recent Q2 and Q3 2026 earnings. We're going to decode the structural moats that protect them and evaluate them through this ruthless, unforgiving lens of deep value investing.
It's going to be a fun one.
But before we get into the whole mess of silicon chips and capital expenditures, I want to share how we actually process this sheer volume of data. Because if you love digging into the mechanics of these companies as much as we do, you can now head over to deepvalues.ai to try the newly developed Deep Value APP.
Which is an incredible tool, by the way.
It really is. It allows you to summon your own super team of AI agents to research companies you are interested in and extract the absolute most critical information from a highly complex market.
It cuts through the noise so fast.
Yeah, exactly. Also, to keep a pulse on macro valuations, you can download the market bubble monitoring app Buffett Indicator from the Apple Store or Bubble Watch from Google Play. They give you daily updates on the Buffett Indicator and the Shiller PE ratio, which are obviously crucial for the exact kind of value analysis we are doing today. So yeah, go download them now.
And just as a necessary piece of housekeeping before we
Mhm.
jump in,
Mhm.
all analysis on this channel is strictly for research purposes
Mhm.
and does not constitute investment advice or services.
Mhm.
Please, conduct your own due diligence before making any financial decisions.
All right, let's untangle this mess. We have to start with the recent earnings report from both of these tech titans because they feel slightly, well, anomalous.
Anomalous is a good word for it.
Yeah. Let's look at Apple first. Their fiscal third quarter of 2026, which ended in June, posted a massive $109.4 billion in total quarterly revenue. That's a 16% year-over-year increase. And their earnings per share surged 29% to $2.02. To put that in perspective, Wall Street consensus was sitting at around like 108.9 billion. So they cleared the bar easily.
Very easily.
But I am genuinely struggling to understand how they are doing this. I mean, the smartphone market is totally saturated. The hardware cycle feels incredibly mature. Literally everyone already has a phone.
Yeah, and the broader macroeconomic context actually makes that top-line beat even more surprising, if you think about it, because consumer upgrade cycles are lengthening significantly.
Right. People aren't buying a new phone every year anymore.
Exactly. People are holding on to their iPhones for 3, sometimes 4 years now. And on top of that, there's this global memory crisis that has forced Apple to strategically increase prices across their entire catalog just to protect their margins.
Wait, so if unit sales aren't exploding, they are just, what, relying on aggressive pricing? Like they are pushing everyone toward the Pro and Pro Max models, jacking up the average selling price.
That's a huge part of it, yes.
Yeah. But there has to be a ceiling to that, right? I mean, eventually consumers will just tap out of paying $1,500 for a phone that looks largely the same as the one they bought 3 years ago.
You'd think so. And that ceiling is a genuine concern for their hardware divisions.
Yeah.
The iPhone segment brought in $54.25 billion, which, is a jump from last year, but it is heavily reliant on those premium price tiers you mentioned.
So where is the real growth coming from, if not the phones?
The true structural shift, like the mechanism that has completely redefined Apple over the last decade, is the services segment. In this Q3 2026 report, services hit an all-time high of $30.74 billion
Wow.
for a single quarter.
$30 billion in 90 days, just from like the App Store, Apple Music, iCloud, Apple Care.
Yep, all of that digital ecosystem revenue.
And I have to imagine the margin on those digital services is radically different than the margin on manufacturing a physical piece of titanium and glass, right?
Oh, the difference is night and day. I mean, hardware requires complex supply chains, massive procurement contracts, physical logistics across oceans. Services operate at gross margins exceeding 70%.
70%! That is wild!
It acts as the primary engine of Apple's bottom line growth. Every time Apple sells a piece of hardware, even if they simply break even on it, theoretically, they are essentially selling a proprietary portal to a high-margin, recurring revenue stream.
That makes so much sense. You buy the phone once, but you pay for iCloud every single month forever.
Exactly. You also have to factor in highly lucrative licensing agreements, like the default search engine placement deal with Google.
Oh, right, where Google pays them just to be the default search on Safari.
Right. That brings in billions of pure profit with essentially zero overhead for Apple.
We also need to pause here for a second and recognize the historical weight of this specific earnings call, because this is Tim Cook's final full quarter as CEO, right?
Yeah. On September 1st, 2026, he is transitioning to executive chairman and handing the reins to John Ternus, who's the current hardware chief.
So, looking at Cook's legacy through the lens of this specific earnings print, the transition from this hit-driven hardware company to a services behemoth is just undeniable.
It really is his masterpiece. When Cook took over in 2011, Apple was viewed as a highly volatile stock.
Yeah.
The sentiment was basically, you are only as good as your latest hardware release.
Right. If the iPhone 5 flopped, the company would take a massive hit.
Exactly. But Cook utilized his deep expertise in global supply chain logistics to build out this massive, inescapable installed base. Incoming CFO Kayvon Parekh actually highlighted on this call that Apple's installed base of active devices reached a new all-time high.
What's the number at now?
Over 2.2 billion active devices globally.
2.2 billion. That denominator is just staggering.
It's massive. Cook basically took a volatile consumer electronics manufacturer and turned it into a predictable, recurring revenue digital utility company.
Okay, so keep that concept of sheer scale in mind. 2.2 billion devices. Because let's pivot over to Amazon now. I read their Q2 2026 numbers, and honestly, I thought there was a typo in the research report.
You're not the only one.
I mean, revenue was $200.6 billion. That's a 20% year-over-year increase. Great, totally normal for Amazon to have huge revenue. But the reported net income for the quarter was $62.6 billion.
The headline number is quite a shock to the system, yeah.
A shock. A year ago, in Q2 2025, their net income was $18.2 billion. You don't just jump from $18 billion to $62 billion in profit in a mature company without something breaking. Did Amazon figure out teleportation logistics?
I wait.
Like, are they shipping packages for free? Because if you look at their traditional retail margins, they are famously razor thin. So where did $62 billion come from?
So this is a perfect example of why statutory net income, which is dictated by generally accepted accounting principles, or GAAP, can be a deeply, deeply flawed metric for evaluating a company's core operational health.
Okay, so it's an accounting trick.
Not a trick, just a rule. That $62.6 billion figure is real on paper, but it is heavily distorted. $53.4 billion of that net income is a non-recurring pre-tax valuation gain.
Wait, $53 billion of the $62 billion?
Yes, it comes entirely from Amazon's equity investments in the artificial intelligence startup Anthropic.
Ooh.
Yeah.
Okay, let me make sure I understand this. This is just paper wealth, right? It's an accounting gain because the assumed value of their investment in Anthropic skyrocketed on the private market.
Exactly.
It doesn't mean Amazon suddenly generated $50 billion more in actual cash from selling dog food, Kindles, and server space.
No, not at all. It is purely unrealized valuation. So when you strip away that non-operating gain, Amazon's actual operating earnings per share stood at $1.88.
Okay, $1.88 is a lot more grounded than what the headline implies.
Right. Now, $1.88 still beat broader market expectations, and their core operating profitability demonstrated really exceptional leverage. It surged 43% year over year to $27.5 billion. But it just highlights the absolute necessity of looking past the headline numbers. You have to isolate the operating profit.
Okay, so if the core operational profit was 27.5 billion, we have to ask where that cash is actually coming from. Because again, it's not the retail side. Retail is a volume game. Selling toothpaste doesn't get you to 27 billion in profit in a single quarter.
No, it doesn't. The profit engine remains Amazon Web Services, or AWS.
The cloud.
The cloud. In this quarter, AWS reported its fastest expansion rate in 18 quarters. Segment sales grew 37% year-over-year to $42.2 billion.
Wow, 37% growth on a base that huge.
Yes, that propels the cloud division to an annualized revenue run rate of approximately $169 billion. And the operating income for AWS alone was $16.6 billion for the quarter.
Okay, so we have two giants posting mind-boggling numbers, but their underlying methods of wealth extraction are fundamentally different. Apple is locking you into this beautiful, seamless, high-margin consumer ecosystem. Amazon is spinning this massive infrastructural wheel of retail logistics and cloud compute so fast that the scale itself becomes the product.
That's a great way to frame it.
Which brings us to the concept of economic moats. A moat, in the traditional Warren Buffett sense, is the structural advantage that protects a company's profits from competitors over the long term. Both Apple and Amazon have constructed incredibly wide moats, but they are built out of entirely different materials.
Completely different architectures.
Yeah. So let's look at Apple's moat first. The research describes it as a highly integrated, hybrid razor and blade business model. But, traditional razor and blade models like Gillette or those cheap inkjet printers, they sell the hardware at a loss to trap you into buying high-margin consumables.
Right. The printer is cheap, the ink bankrupts you.
Exactly. But Apple is charging a massive premium for the razor and the blades. How do they pull that off?
The integration is the key. They control the entire stack, top to bottom. They don't just assemble parts. They design the proprietary hardware, they design the custom silicon chips inside that hardware, and they control the closed-source operating systems that run on it.
Everything is custom-built to work together.
Yes. And this creates a user experience characterized by seamless interoperability, which in turn creates massive switching costs.
Okay, let me try a different analogy here, because I was thinking about this earlier. People often compare Apple to a luxury country club. The initiation fee is steep buying the iPhone, but once you're inside, everything is so beautiful and perfectly manicured, so you happily pay for the overpriced drinks, which is the 30% App Store tax in the services.
It's a common comparison, yeah.
But to me, that just explains why people like Apple. It doesn't explain why they can't leave. Leaving the Apple ecosystem isn't just like canceling a country club membership. It's more like trying to move to a new country where none of your appliances plug into the wall, your bank doesn't exist, and you can't read the language.
That is a much more accurate representation of structural switching costs, honestly.
Right, your iCloud data, your save passwords, your AirTags, your Apple Watch, none of it translates to an Android device. You lose your iMessage group chats. The friction isn't just financial, it's deeply technological and even social.
The social aspect is huge, especially in the US. The friction of migrating just a single node, say, you decide to move from an iPhone to a Samsung Galaxy, it actually degrades the utility of all your other Apple products.
Yeah, your watch becomes useless.
Exactly. Your Apple Watch loses its primary hub, your AirPods lose their seamless pairing, you can't airdrop files to your Mac anymore. Empirical studies on consumer behavior cited in the research consistently demonstrate that iOS user retention rates hover near 90%.
90%.
Well,
9 out of 10 people are effectively locked in for life.
And that retention is driven by ecosystem dependence, not just mere brand affinity. Furthermore, Apple possesses unparalleled intangible asset value. Their brand equity allows them to charge a 40 to 50% premium over equivalent Android hardware.
Because it's a status symbol.
Exactly. And finally, their massive scale gives them preferential pricing from premier suppliers. If Apple wants 1 billion OLED screens, they get the best price, and they get first priority on the assembly line, which creates barriers to entry that even other well-capitalized tech giants struggle to overcome.
So Apple's moat is essentially a technological walled garden. Let's shift to Amazon. Because Amazon's moat isn't a walled garden, it feels more like they own the actual ground you walk on. The research refers to it as the Amazon flywheel. How does this physical moat function?
Well, Amazon's moat is highly diversified and heavily physical, which makes it incredibly capital-intensive to maintain. The revenue structure is spread across several pillars. Online and physical stores make up roughly 40% of revenue. Third-party seller services are about 24%.
So that's Amazon taking a cut of other people selling on their site.
Right. Then AWS is 21%, advertising is 9%, and subscriptions like Prime are 6%.
It's a much more balanced pie chart than Apple, which is still roughly 50% dependent on iPhone hardware sales alone.
It is much more balanced. And the moat protecting the retail portion of that pie has recently undergone a massive physical upgrade. Historically, Amazon operated a single national hub model for fulfillment in the United States.
Meaning what exactly?
Meaning if you ordered a niche product in New York, it might actually ship from a centralized warehouse all the way in Nevada. But recently, they transitioned to an 8-region decentralized network.
I saw that in the report. But I need to understand the mechanics of this, because why does moving from a national hub to 8 regional hubs matter so much? On paper, it sounds like they just multiplied their overhead by 8.
It seems like that, but it actually changes the entire physics of their delivery infrastructure. Under a decentralized model, inventory is localized. When you order that same niche product in New York now, it is already sitting in a regional node in New Jersey.
Ah, so it doesn't have to fly across the country.
Exactly. This drastically lowers the cost to serve.
Cost to serve meaning like the variable costs of shipping.
Yes. Think about middle-mile freight. You are no longer flying a package across the country or paying for long-haul trucking. You are relying on localized, short-haul logistics.
So less gas, basically.
Lower fuel costs, reduced wear and tear on vehicles, and it requires fewer touch points, which lowers labor costs. And simultaneously, it accelerates delivery speeds. You get it same day or next day.
Right.
They have created a logistical infrastructure that competitors simply cannot economically replicate. If you want to compete with Amazon in e-commerce today, you don't just need a really good website. You need hundreds of billions of dollars in physical warehousing and a dedicated fleet of cargo aircraft.
Okay, that covers the physical retail moat.
Right.
But what about the cloud? Because AWS is the real profit engine, as we discussed, and Google and Microsoft are fighting them tooth and nail in that space. What is keeping enterprise clients locked into AWS? Why not just switch to Azure?
The AWS moat relies on a different type of switching cost. Deep integration with proprietary silicon.
Silicon again.
Always silicon. As the AI arms race heats up, the cost of raw compute is everything. Rather than relying entirely on third-party hardware, Amazon has developed its own custom silicon for AWS, specifically the Trainium2 chips.
I was reading about Trainium2 in the research. It states it offers compute at roughly $4.80 per hour compared to $9.80 for comparable NVIDIA H100 instances.
Massive difference.
Yeah, how are they cutting the cost of compute by 50%? Are NVIDIA chips just massively overpriced, or is Amazon doing something magical?
It comes down to hardware architecture. NVIDIA's GPU's graphics processing units are incredibly powerful and versatile, but they carry overhead for functions not strictly related to machine learning.
Like rendering graphics.
Exactly. Amazon's Trainium chips, on the other hand, are ASICs application-specific integrated circuits. They are designed from the ground up to do one thing and one thing only: train deep learning models. By stripping out all that unnecessary architecture, they increase power efficiency and dramatically lower the physical cost of manufacturing.
Oh, I see. So they pass those savings on to the AWS client.
Right. When you are an enterprise client running large language models that require tens of thousands of hours of compute time, a 50% price difference isn't just nice to have, it's existential.
Yeah, that's millions of dollars.
Exactly. By offering superior price-to-performance ratios that are deeply embedded within the AWS architecture, Amazon basically locks these enterprises in. Once your data pipelines, your storage solutions, and your training models are built natively on AWS utilizing Trainium, the engineering hours and financial costs required to migrate all of that architecture over to Microsoft Azure or Google Cloud become economically prohibitive.
You're stuck.
You're completely stuck.
So Apple locks the consumer in with seamless software and hardware integration, and Amazon locks the enterprise in with logistics networks and cheap proprietary AI compute.
That's the summary, yeah.
But here is where the narrative shifts, I think. Because when castles get this big, they attract the attention of the sovereign.
Regulators.
The regulators. We are seeing a massive wave of systemic risk for both of these companies, driven by governments literally trying to dismantle these exact moats we just described. Let's look at the regulatory and geopolitical headwinds, starting with Apple in the United States.
It's getting intense over there.
It is. The Department of Justice has filed a landmark antitrust lawsuit, United States v. Apple Inc. They are alleging Apple maintains an illegal smartphone monopoly. But, playing devil's advocate here, Apple doesn't have 100% market share. Anyone can walk into a store today and buy a Samsung Galaxy or a Google Pixel. So how can the DOJ argue it's an illegal monopoly if there is clear choice?
Well, the DOJ's argument doesn't actually hinge on 100% market share. It centers on how Apple leverages its ecosystem to suppress competition and lock consumers in.
The walled garden again.
Exactly. The legal term is exclusionary conduct. Specifically, the DOJ points to Apple's suppression of what they call super apps.
Super apps like WeChat in China, right? Where you can message, pay bills, and order food all within one single app.
Yes, exactly like WeChat. A super app could theoretically host its own mini ecosystem of programs completely independent of the iOS operating system. If consumers spend all their time inside a super app, it makes it incredibly easy for them to switch from an iPhone to an Android device.
Because the super app exists on both platforms, so you don't lose anything.
Precisely. The DOJ alleges Apple deliberately restricted the development of these super apps in the U.S. market to preserve their hardware mode.
Wow. And there's also the whole green bubble versus blue bubble debate in the lawsuit, right?
Yeah, the degradation of cross-platform messaging. The DOJ argues that Apple deliberately makes SMS messaging between iPhones and Androids visually unappealing and functionally inferior.
Like compressing photos so they look terrible.
Compressing photos, breaking group chats, lacking read receipts. They argue Apple does this to create social friction, particularly among younger demographics, to pressure people into buying iPhones.
Teenage peer pressure as a corporate strategy.
The DOJ seems to think so. Furthermore, the DOJ alleges Apple restricts third-party smartwatch interoperability. If you try using a high-end Garmin watch with an iPhone, it simply doesn't have the same seamless integration or notification access as an Apple Watch. The DOJ views this not as a technical limitation, but a deliberate anti-competitive strategy to force you to buy the Apple Watch.
Man, they are going after every brick in that wall, and the regulatory environment across the Atlantic is arguably even more hostile. The European Union has fully rolled out the Digital Markets Act, or the DMA, and this isn't just a lawsuit that might take years. This is active legislation forcing Apple's hand today.
Oh, Europe is not playing around. The DMA has explicitly targeted the App Store. It is actively forcing Apple to permit third-party app marketplaces and alternative payment processors on European devices.
Which strikes right at the heart of that services revenue we talked about earlier. If a developer like Epic Games or Spotify can route their payments around Apple's proprietary system, that completely undermines the 30% commission structure.
It is a direct hit to their most lucrative margin engine. And the European Commission has already shown a willingness to levy massive non-compliance fines if Apple tries to drag its feet.
It's not just Europe either.
No. We're also seeing parallel investigations in jurisdictions like Brazil, led by their antitrust authority. It is a globally coordinated effort to dismantle the rent extraction mechanisms of Apple's walled garden.
And beyond the courtrooms, there's a massive geopolitical risk outlined in the research: Apple's supply chain. They are perilously reliant on China. Now, I know Tim Cook has been aggressively trying to pivot manufacturing to India and Vietnam over the last few years. But you can't just pick up a factory in Shenzhen that employs 300,000 specialized workers and drop it in Mumbai, can you?
No, you absolutely cannot. The scale and complexity of the Chinese manufacturing ecosystem is truly unparalleled. It has been optimized over decades. The physical infrastructure, the proximity of component suppliers, the highly skilled labor pool, it is deeply, deeply entrenched.
So the pivot is going to take a long time.
Yes. While Apple is executing this strategic diversification, it is highly capital-intensive and fraught with logistical vulnerabilities. Any sudden severe deterioration in Sino-American trade relations, such as prohibitive tariffs or retaliatory bans on Apple products by the Chinese government, would inflict immediate and perhaps irreparable damage on Apple's revenue trajectory. The pivot to India and Vietnam will take years to fully mature.
So Apple is fighting a multi-front war, the DOJ in the US, the DMA in Europe, and navigating a geopolitical minefield in Asia. What about Amazon? I assume the regulators are certainly not giving them a free pass.
Definitely not.
The U.S. Federal Trade Commission, alongside 17 state attorneys general, has a landmark antitrust lawsuit against Amazon scheduled for trial in October 2026. I was reading through the FTC's grievances, and it seems like their main problem is this anti-discounting mechanism. It sounds like Amazon is basically holding third-party sellers hostage.
That is essentially the crux of it. The FTC's litigation focuses heavily on what they term anti-discounting measures. They allege that Amazon actively penalizes third-party sellers if those sellers dare to offer lower prices for their goods on competing platforms.
Okay, let's break that down. So if a merchant sells a coffee mug for $10 on Amazon, but they try to sell it for $8 on Walmart.com or on their own personal Shopify site, what happens?
Well, the FTC alleges that Amazon's algorithms crawl the web, detect the price discrepancy, and retaliate by suppressing that seller's visibility in the Amazon search results or outright removing their buy box privilege.
And losing the buy box means you basically don't exist on Amazon.
Exactly. Because Amazon controls such a vast portion of e-commerce traffic, losing visibility on Amazon is essentially a death sentence for a small merchant. The FTC argues this effectively forces sellers to keep their prices artificially high everywhere else on the internet just to survive on Amazon.
That is a staggering amount of leverage to have over the entire retail economy. And the FTC is also targeting the forced bundling of Prime with Fulfillment by Amazon, right?
Yes, Fulfillment by Amazon, or FBA. The FTC argues that Amazon conditions a seller's eligibility for the coveted Prime badge on their utilization of Amazon's own proprietary logistics network.
Meaning you have to use Amazon's warehouses if you want to be a Prime item.
Exactly. If a seller wants the Prime badge, which is crucial for conversion rates, people actively filter for Prime delivery. They're essentially forced to pay Amazon for warehousing and shipping, even if the seller could fulfill the orders more cheaply themselves using FedEx or UPS.
So it's a monopoly tying arrangement.
Right. If the FTC secures a permanent injunction forcing the decoupling of FBA from Prime eligibility, it would fundamentally deteriorate the volume and margin structure of Amazon's entire logistics network.
There is also a detail in the report about a massive $2.5 billion settlement regarding dark patterns. I've heard this term in web design. Can you explain the mechanics of a dark pattern for those who don't know?
Sure. Dark patterns are basically user interface designs deliberately engineered to manipulate consumers into making choices they wouldn't otherwise make.
Like accidentally opting into an email newsletter because the checkbox was hidden.
Exactly. In this specific case, the FTC argued that Amazon utilized dark patterns to trap consumers in Prime subscriptions. They made the sign-up process totally frictionless, literally a single click, but they made the cancellation process intentionally labyrinthine.
You have to click their 10 pages just to say no.
Yes, requiring users to navigate multiple confusing screens, ambiguous warnings, and hidden buttons. The FTC argued that seamless cancellations would adversely affect Amazon's bottom line, so they engineered heavy friction into the exit process.
A $2.5 billion settlement just for making the cancel button hard to find. It definitely casts a shadow over their famous customer obsession ethos.
It's certainly a bad look.
Now, there is one more regulatory hurdle for Amazon that just hit in August 2026. The closure of the Section 321 de minimis loophole. This has been all over the financial news. How does this loophole work, and how does its closure impact Amazon? Because on the surface, it sounds like it should hurt their competitors way more than them.
It's a complicated one. The de minimis exemption was a trade rule that allowed international packages valued under $800 to enter the United States entirely duty-free, without any customs inspections or tariffs.
Under $800, okay.
Over the last few years, this loophole was heavily exploited by Chinese ultra-fast fashion and e-commerce competitors, namely Shein and Temu. They built their entire business models around shipping millions of individual low-value packages directly from Chinese factories straight to U.S. consumers.
So they completely bypassed the tariffs that traditional retailers had to pay when importing bulk shipping containers.
Exactly.
Right, so closing the loophole stops Temu and Shein from flooding the market with cheap duty-free goods. Wouldn't Amazon be thrilled about that?
You'd think so, but it is a profound double-edged sword. While it severely damages the unit economics of Amazon's direct ultra-discount rivals, it also permanently increases procurement and fulfillment costs for Amazon's own ecosystem.
Oh, because Amazon sellers use it too?
Yes, a massive percentage of independent third-party sellers on Amazon relied on that exact same direct-to-consumer import model from Asian manufacturing hubs to maintain their margins. With the loophole closed, those sellers now face higher tariffs, extensive customs paperwork, and significant border delays.
Who pays for that?
The consumer. Those increased costs will inevitably be passed on to the consumer, translating into higher retail prices on Amazon's platform, which hurts demand.
So to summarize this whole regulatory landscape, both companies have global governance actively trying to dismantle the exact moats that generate their cash. It's a tough spot.
It is.
But if we move into the operational reality of 2026, the research suggests that both Apple and Amazon face an even more immediate internal threat. And that threat is the skyrocketing, eye-watering cost of staying at the top of the technology food chain. We're entering the Silicon Wars, and the numbers here are frankly terrifying.
They are unprecedented.
Let's look at Apple's cost architecture first. The report calls it Apple's variable cost nightmare. Now, Apple designs its own chips. The M series for the Macs, the A series for the iPhones. They are brilliant pieces of engineering. But Apple operates what's called a fabless model, right? They don't actually own the multi-billion-dollar factories that print the silicon.
Correct. They design the architecture of the custom silicon down to the atomic level, but they are entirely reliant on the Taiwan Semiconductor Manufacturing Company, or TSMC, for the actual physical fabrication of the chips.
And TSMC is essentially a global monopoly at the absolute bleeding edge of semiconductor manufacturing.
Yes.
So why is that a nightmare for Apple? I mean, don't they have enough scale to negotiate good prices with TSMC?
Scale only goes so far when you literally have no alternative supplier. The semiconductor landscape is currently navigating a severe pricing crisis regarding advanced manufacturing nodes. Apple aggressively utilizes the absolute bleeding edge of fabrication, currently the 3-nanometer and upcoming 2-nanometer processes, to maintain the battery life and processing superiority of their hardware.
Right. Smaller nanometers means more transistors, better battery.
Exactly.
Yeah.
The issue is that manufacturing at 3 nanometers requires extreme ultraviolet, or EUV, lithography machines. These machines are made by a single company in the world, ASML in the Netherlands, and they cost hundreds of millions of dollars each.
Good Lord.
Because the capital expenditure to build these foundries is so astronomical, TSMC has dramatically increased their wafer pricing. To give you a sense of scale, producing chips on the 3-nanometer and 2-nanometer nodes costs nearly 4 times as much as legacy 28-nanometer processes.
4 times as much. That is a massive variable cost headwind. So if the primary brain of a $1,000 iPhone suddenly costs exponentially more to physically manufacture, and TSMC is passing that cost straight to Apple, Apple is basically caught between a rock and a hard place.
Precisely. The fabless model saves Apple from having to spend $50 billion building their own fabrication plants, which is great, but it leaves them captive to TSMC's variable pricing. So they are faced with a brutal choice. They either compress their own gross margins, meaning they absorb the increased chip cost to keep the retail price flat, or they raise retail prices and risk destroying unit demand in geographies where consumers are highly price sensitive.
So Apple preserves its capital by outsourcing, but they bleed margin on the variable cost.
Exactly.
Now let's look at Amazon, because Amazon is taking the exact opposite approach to the Silicon Wars, and their cash flow statement looks like a crime scene. Let me read this number from the report. Over the trailing 12 months ending in June 2026, Amazon's statutory free cash flow is a negative $7.6 billion.
Yes. Negative $7.6 billion.
I have to be honest, if I am looking at a balance sheet and I see a company bleeding nearly $8 billion in cash, my instinct is to hit the sell button immediately. Is Amazon fundamentally broken? How can a company with over $700 billion in top-line revenue lose $7.6 billion in cash flow?
The instinct to run is very understandable if you were just looking at the headline number. But Amazon is not broken. It is aggressively mutating.
Mutating.
To understand that negative $7.6 billion, you have to dissect their capital expenditure, or CapEx.
Okay, CapEx.
Capital expenditure is the money a company spends to acquire, upgrade, and maintain physical assets. In 2023, Amazon's CapEx was around $53.4 billion. Fast forward to the trailing 12 months of 2026, their CapEx has expanded to a jaw-dropping $169 billion.
$169 billion in capital expenditures in a single year. You could buy entire sovereign nations for that amount of money. What on earth are they physically buying?
They are buying the physical infrastructure for the next decade of human computing. That massive cash outflow is driven almost entirely by the generative AI arms race. They are procuring hundreds of thousands of NVIDIA H100 and upcoming Blackwell GPUs, which cost tens of thousands of dollars per unit.
Right.
They are aggressively scaling the manufacturing of their own custom Trainium 2 chips that we talked about. But most importantly, they are building the massive hyperscale data centers required to house, power, and cool all of this silicon.
And building those data centers isn't just about pouring concrete and laying fiber optic cables. It's about securing power. The research report highlights a fascinating nuclear power play. Can you explain why a tech company is suddenly getting into the nuclear business?
Because the limiting factor for global AI expansion right now is actually not silicon, it is electricity.
Really? Just raw power?
Yes. Generative AI models, particularly during the training phase, require an astonishing amount of compute power, which translates into massive electrical draw. The national power grids are becoming severely constrained by these data centers.
So what did Amazon do?
To secure the energy required for their infrastructure, Amazon executed a 1,920 megawatt power purchase agreement with Talon Energy at the Susquehanna nuclear plant in Pennsylvania.
Wait, they literally bought the output of a nuclear power plant. They bypassed the standard grid entirely.
They established what's called a front-of-the-meter arrangement. The data center is co-located with the nuclear plant to secure long-term, carbon-free baseload power.
That is insane.
This is exactly why their free cash flow is negative. They are choosing to spend hundreds of billions of dollars today to guarantee they maintain an absolute monopoly over the infrastructure layer of tomorrow.
So just to contrast them, Apple preserves its cash by outsourcing fabrication to TSMC, while Amazon is spending hundreds of billions to literally own the AI infrastructure layer right down to the nuclear reactors.
That's the divergence, yeah.
This fundamental difference in how they manage their cash and capital expenditures leads us directly into the ultimate test of this deep dive, the deep value verdict.
Here we go.
This is where things get heavily analytical. We are going to apply the rigorous standards of value investing, the frameworks popularized by Benjamin Graham and utilized by Warren Buffett, to determine if either of these companies represents a true margin of safety for an investor or if they are just massive hype bubbles.
The moment of truth.
Let's start with Apple. We know they make an absurd amount of money. Their free cash flow for the trailing 12 months is $129.1 billion. But the research calls Apple's financial structure a masterclass in financial engineering. Specifically, it highlights their use of negative net working capital. I need you to break this down for me. How does a company operate with negative net working capital, and why is it a good thing?
To understand net working capital, you have to think about the cash flow cycle of a normal business. Usually a company has to buy raw materials, build a product, put it on a shelf, and wait for a customer to buy it. Their cash is tied up in inventory for months.
Right, which restricts their flexibility.
Exactly. Apple flips this dynamic entirely due to their immense market dominance. Negative net working capital means Apple collects cash instantly from consumers the moment they buy an iPhone or an App Store subscription. But Apple negotiates incredibly aggressive payment terms with its own suppliers, companies like Foxconn and TSMC. Apple might stretch out those payments for 90 or even 120 days.
Wait, so they get paid on day one by the customer, but they don't actually pay their bills for building the phone until day 120.
Exactly. They are effectively utilizing their immense negotiating power to borrow billions of dollars from their own supply chain entirely interest-free.
Wow.
They use that cash to fund their daily operations, invest in research, or earn interest in the bank, all before they ever have to write a check to their suppliers. It is a supremely efficient use of capital.
That is brilliant. It's like a massive interest-free loan from the entire global manufacturing sector. But the really wild part of Apple's financial engineering is their share buyback program. The report notes they authorized a massive $100 billion expansion to the buyback program in Q2 2026 alone.
Just massive amounts of capital return.
And over the last decade, they've spent over $600 billion repurchasing their own stock. Now, I understand that buying back stock reduces the supply of shares, which naturally drives the price up, but the research says this buyback program fundamentally distorts Apple's balance sheet. How?
This is where accounting mechanics get a little counterintuitive. When a company buys back its own stock on the open market, it retires those shares. By shrinking the denominator, the total number of outstanding shares, you artificially inflate earnings per share, or EPS. The same amount of net income divided by fewer shares means higher EPS, which Wall Street absolutely loves.
Right, the pie is the same size, but there are fewer slices, so each slice looks bigger.
Perfect analogy. But it has a drastic effect on the balance sheet's equity. The research shows that Apple's retained earnings actually collapsed into negative territory, from a peak of $98 billion in 2017 down to negative $15 billion in 2024.
Hold on, how can the most profitable company in the world have negative retained earnings? That sounds like they are bankrupt.
It is a quirk of the accounting. They have negative retained earnings because their ferocious share buyback program actually exceeded their annual net income in those years.
They bought back more stock than they made in profit.
Yes, they were returning more cash to shareholders than they were officially earning in profit. They utilized their massive historical cash reserves, and in periods of low interest rates, they actually took on cheap debt to fund the difference.
They borrowed money just to buy back their own stock.
Yes. And when you distribute that much capital, you mathematically shrink the company's book value, the total equity of the company. Now, think about the metric return on equity, or ROE. ROE is calculated as net income divided by shareholders' equity.
Okay, I follow.
If you generate $100 billion in net income, but you have mathematically engineered your equity base to be incredibly small through these massive buybacks, the resulting ROE skyrockets to absurd levels. Apple's ROE currently sits at an astronomical 115%.
So on paper, they look like the most efficient company in the history of capitalism, generating 115% return on equity, but it's largely because they've engineered the denominator down to almost nothing.
Exactly. It's brilliant financial engineering.
So what is the final value verdict on Apple? If I am a strict Benjamin Graham disciple looking for a bargain, does Apple pass the test?
It comprehensively fails the strict price-based value acquisition tests. At current market prices hovering around $270 a share in July 2026, the price-to-earnings ratio is 32.6, and the price-to-book ratio is a staggering 37.2.
So it's extremely expensive.
The market fully recognizes Apple's quality premium and has priced it for absolute perfection.
The research includes a discounted cash flow, or DCF model. Let's walk through that for a second because I want to understand the actual math behind the valuation. What is DCF actually telling us?
Sure. A discounted cash flow model is a fundamental valuation method used to estimate the intrinsic value of an investment based on its expected future cash flows. Essentially, you project how much actual cash the business will generate over the next decade.
Okay.
But a dollar tomorrow is worth less than a dollar today due to inflation and opportunity cost, so you had to discount all of that future cash back to its present value. You factor in a discount rate that accounts for the time value of money and the risk of the investment.
Okay, so if we run a DCF on Apple's $110 billion normalized base year free cash flow, and we assume they continue to grow at their 10-year historical average of roughly 5.5% annually, what is the calculated intrinsic value of a single Apple share?
Under that nominal growth scenario, utilizing a standard discount rate, the intrinsic value per share calculates out to exactly $143.
$143. But the market price is $270. That is an enormous gap.
It is a massive premium. To mathematically justify the current $270 valuation, the market is implicitly modeling that Apple's long-term annual free cash flow growth will approach 10% indefinitely, which is double their historical decadal average.
That seems unlikely given how saturated the market is.
Right. Alternatively, the market is utilizing a significantly lower discount rate, basically treating Apple equity as if it were as safe and risk-free as sovereign government bonds.
So there's absolutely zero margin of safety here. If Apple stumbles even slightly, if the iPhone 18 is a total dud, or the EU permanently breaks the App Store, the stock has no cushion to fall back on.
Which is exactly why Warren Buffett and Berkshire Hathaway have been systematically trimming their massive Apple position throughout 2024, 2025, and into 2026.
Oh, that makes total sense now.
Buffett recognized the intrinsic value back in 2016 when he initiated the position at around $35 a share. But at $270, the risk-reward profile has fundamentally changed. He is executing disciplined risk and tax management. Apple is an incredible business, perhaps the most phenomenal cash generator in world history. But at this price, it is fundamentally not a deep value investment.
Wow. Okay, so Apple is priced for absolute perfection. Let's flip the script and run this exact same deep value analysis on Amazon. Now, earlier we established that Amazon's statutory free cash flow is negative $7.6 billion.
Yes, the scary number.
If they have negative cash flow, how can you even run a discounted cash flow model? Don't you need positive cash flow to project future cash flow? Don't they just fail every value test automatically?
If you rely purely on statutory headline GAAP accounting numbers, yes, they fail miserably. But modern value investors, particularly those following a quality value paradigm, look much deeper than the statutory numbers. They look for what Warren Buffett calls owner's earnings.
I've heard this term before. What is the fundamental difference between statutory free cash flow and owner's earnings?
It comes down to how you treat capital expenditures. Statutory free cash flow takes operating cash flow and subtracts all capital expenditures, regardless of what that money was actually spent on. But we established that Amazon's $169 billion in CapEx is heavily skewed toward aggressive, discretionary growth buying nuclear power plants, building hundreds of new AI data centers, manufacturing Trainium chips.
Right, they are building for the future, not just maintaining today.
Exactly. Owner's earnings attempts to find the true underlying profitability of the core business as it exists today. To find it, you strip away all of that discretionary growth spending, and you only deduct maintenance CapEx.
Maintenance CapEx, meaning the bare minimum spending required to just keep the lights on.
Correct. Replacing broken servers in existing AWS data centers, repaving the parking lots at current fulfillment centers, maintaining the existing delivery vans. It is the cost to sustain the current operational output, not the cost to conquer the future.
So it's almost a thought experiment. If Amazon just hit the pause button today, stopped trying to conquer the generative AI world, stopped building new warehouses, and just maintained their current retail volume and existing AWS contracts, what would their cash flow look like?
Exactly. And according to the research analysis, Amazon's maintenance CapEx is estimated at roughly $25 billion a year.
Oh.
When you adjust the formula, taking their massive operating cash flow and subtracting only that $25 billion maintenance figure, Amazon reveals a staggering $122.8 billion in owner's earnings over the trailing 12 months.
122.8 billion. That is completely hidden beneath the surface of the CapEx spending spree. That is roughly equivalent to Apple's free cash flow.
It is hiding in plain sight. It proves that the core engines of their decentralized retail logistics and their current AWS cloud services are phenomenally profitable. The management team is simply choosing to aggressively reinvest every single dollar of that profit, plus taking on some debt to fund future domination.
So what happens when we run the DCF model utilizing that $122.8 billion owner's earnings figure instead of the negative statutory free cash flow?
It paints a vastly different picture than Apple. If we assume a nominal historical growth trajectory, where owners' earnings expand at roughly a 15% compound annual growth rate for the next 5 years, driven by the structural transition to generative AI compute and their incredibly high-margin advertising business, and then decelerate to a terminal growth rate, the intrinsic value of Amazon's equity calculates out to roughly $397 per share.
$397 intrinsic value. And what is the stock currently trading at, according to the report?
The current market price listed in the July 2026 report is $236.13.
That is a massive discrepancy. The intrinsic value is well above the current trading price.
It offers a very rare, quantifiable margin of safety for a mega-cap technology monopoly. Even if you want to be extremely conservative and apply a strict 30% margin of safety to that $397 intrinsic value, your actionable buy price calculates to $277.91.
Which is still significantly higher than the current market quotation of $236.
Okay.
So the deep value verdict here is that Amazon, despite bleeding cash on the statutory paperwork, is actually a hidden bargain. The broader market is underpricing its true cash-generating power because everyone is panicked by the massive CapEx numbers.
The market often operates on short-term horizons. They're penalizing Amazon for their aggressive CapEx, viewing it as a drag on quarterly profitability. But value investors view that CapEx as a massive down payment on an insurmountable future monopoly.
That explains so much.
This is exactly why Buffett's Berkshire Hathaway initiated a position in Amazon back in 2019 and has held it steadily since. They recognize that Amazon's structural competitive advantages, their logistical and cloud monopolies, and their hidden owners' earnings supersede static, surface-level book value assessments.
This has been an absolutely phenomenal breakdown. We've gone from the stratosphere of trillion-dollar valuations all the way down to the atomic level of silicon wafers, nuclear power plants, and obscure accounting ledgers.
It's been a journey.
To synthesize this incredible journey, Apple is the ultimate asset-light cash compounder. They rely on fierce brand loyalty, incredibly high technological switching costs, and ruthless financial engineering to generate infinite returns on minimal retained capital. But the market knows this, and it has priced Apple's equity to the absolute moon, leaving essentially no margin of safety.
Right. And conversely, Amazon is an asset-heavy infrastructure conqueror. They are currently masking their true, immense profitability behind the greatest AI spending spree in corporate history. By looking past the negative statutory cash flow and identifying the hidden owner's earnings, we uncovered a structural value asymmetry.
It really is a tale of two entirely different philosophies of capitalism.
Absolutely.
Before we sign off, I want to leave you, the listener, with provocative final thought. Something for you to mull over as you digest all these numbers, whether you're driving to work or just staring at your own iPhone. We've established that right now, Amazon completely dominates the cloud, and Apple completely dominates the device in your pocket.
The infrastructure versus the edge.
Exactly. The battleground is drawn. But as artificial intelligence evolves at this breakneck pace, we are approaching a technological fork in the road. Think about how you will interact with technology in 5 years. Will the future of computing live entirely in the cloud? Because if AI models become so impossibly large and complex that they require nuclear-powered Amazon data centers to process every single prompt, then the iPhone essentially becomes just a dumb piece of glass.
A very expensive piece of glass.
Right. It becomes a beautiful, expensive terminal that just routes your queries back to Amazon's servers.
And that scenario represents the ultimate existential risk for Apple's walled garden. If the value is entirely in the centralized compute, the localized hardware becomes completely commoditized.
But what if the exact opposite happens? What if edge AI becomes the dominant paradigm? What if Apple's custom silicon, those highly expensive 3-nanometer chips they buy from TSMC, become so incredibly powerful and their localized on-device AI models become so efficient that your iPhone can process complex AI tasks locally?
Without needing the cloud at all.
Entirely bypassing the cloud, bypassing Amazon's nuclear-powered data centers completely?
If the compute shifts to the edge, the device retains its premium value and its moat. And conversely, those massive CapEx investments Amazon is making in centralized cloud data centers could face a severe utilization crisis.
The winner of this hardware versus cloud war, this battle between the pocket and the data center, will ultimately define the next decade of human technology. And as we've seen today, the financial ledgers of both companies show they are preparing for that exact war in entirely different ways.
It's going to be fascinating to watch it play out.
It really is. Thank you for joining us on this deep dive. We hope you walk away looking at the next earnings headline with a slightly more skeptical and far more informed perspective. Keep questioning the numbers, look for those hidden owners' earnings, and remember, just because you can see a jagged white line on the X-ray doesn't mean you know how the bone actually broke. We will catch you on the next deep dive.